Here's a fun quiz. What do you get when America's largest used car retailer posts a GAAP net loss of $121 million, writes down all its goodwill, hires a CEO from the hotel industry, and still beats earnings estimates by 55%? You get CarMax's Q4 fiscal 2026 and one of the more confusing earnings reports of the season.
Let's be precise. On April 14th, CarMax reported adjusted EPS of 34 cents, beating the street's 22-cent estimate by more than 50%. Revenue came in at $5.95 billion, beating the $5.68 billion estimate. By every comparable metric, this was a beat.
So why does the stock feel like it's on life support? Down more than 40% from its 52-week high of almost $72, trading at $41 and change, with an average analyst price target of exactly $42. Almost no upside from here.
Because the beats were against a very low bar, the goodwill impairment signals management lowered their long-term expectations for the business, and the structural questions around margin compression and competitive pressure from Carvana have not gone away. That's what we're unpacking today. CarMax, ticker KMX.
Let's set the scene. CarMax was born in 1993 inside Circuit City. The electronics retailer wanted to apply the same no-nonsense, no-haggle pricing model that had worked for TVs and stereos to used cars. The idea was radical at the time. No more backroom negotiations. You see the price, you pay the price.
CarMax was spun off from Circuit City in 2002 and grew steadily into the country's dominant used vehicle retailer. Today, they operate more than 235 stores across the United States and are by far the largest player in a fragmented market. Consumer cyclical sector, auto dealerships industry, headquartered in Richmond, Virginia.
Two main business lines. CarMax Sales Operations handles the buying, reconditioning, and selling of used vehicles, both retail to consumers and wholesale at auction. And CarMax Auto Finance, which they call CAF, is their captive lending arm. They originate auto loans, hold a portion on balance sheet, and securitize the rest. That finance business has $17+ billion in receivables.
The genius of the original model was consistency. Every CarMax reconditions vehicles to the same multi-point inspection standard, offers the same no-haggle price, and provides the same financing experience. At scale, that's a real competitive advantage over the typical independent used car dealer. 30,000 employees, a nationwide footprint.
But here's where it gets complicated. Carvana came along and proved you could do most of this entirely online. Buy a car on your phone, have it delivered to your driveway. CarMax is now racing to build an omni-channel version, physical plus digital, before the digital natives fully eat their lunch.
The moat is the combination: brand trust built over 3 decades, the physical reconditioning and delivery network, and the captive finance arm. Not easy to replicate, but not enough on its own if the digital experience continues to lag.
And that's the core of the Why Now story. New CEO, stock at multi-year lows, tariff tailwinds pushing buyers toward used cars as new vehicle prices spike. The question is whether this is a turnaround you want to be early for or a value trap you want to avoid. On March 16, 2026, CarMax announced Keith Barr as its new president and chief executive officer. Barr is 55 years old. He was CEO of Intercontinental Hotels Group, IHG, from July 2017 to June 2023. He joined IHG in the year 2000 and held senior roles across the Americas, Asia, Middle East, and Africa, including 4 years running IHG's Greater China business. He also serves on the board of MGM Resorts.
That is, every qualifier except automotive. This is the first CarMax CEO recruited from entirely outside the car business. The signal the board is sending is clear. They don't think CarMax needs someone who knows how to move metal. They need someone who can build a modern consumer-facing experience at scale, digital and physical, and execute cost discipline. The Barr hire is a transformation bet.
Barr's first major signal came on this Q4 earnings call. Just weeks into the role, he raised the SG&A cost reduction target from $150 million to $200 million, targeting that as an exit rate by the end of fiscal 2027. Bold commitment for a CEO who's been in the seat for less than 30 days. All right, Lana, the numbers.
Starting with valuation, CarMax is trading at $41.60 with a market cap of $5.9 billion. That gives you a price to sales of just 0.21 times on $27.76 billion in fiscal 2026 revenue. That is remarkably cheap. Price to book is 1.04. Adjusted price to earnings is 14.9 times on fiscal 2026 actuals, or 17.3 times on the forward fiscal 2027 estimate of $2.40 per share.
So at 0.21 on price to sales, you're paying 21 cents for every dollar of revenue. That's deep value territory for a brand this recognizable.
It is. But context matters. Q4 fiscal 2026 revenue was $5.95 billion, down 8.1% from the same quarter a year ago. Q4 is CarMax's slowest quarter seasonally, the winter drags. But that year-over-year decline matters because it tells you demand is softening, not just seasonally weak.
And how did the actual quarter come in versus estimates?
Revenue beat, $5.95 billion versus $5.68 billion estimated, a 4% beat. Adjusted EPS of 34 cents beat the 22-cent estimate by 55%. Those are the headline wins. Now, GAAP EPS was negative 85 cents. The gap between adjusted and GAAP is the story. Two adjustments: a non-cash goodwill impairment of 99 cents per share and 20 cents of restructuring charges. Together, that's $1.19 add back.
When management writes down goodwill, they're saying the future earnings power of the business is worth less than they thought when they put those assets on the books. That's not a one-quarter accounting decision. It's a permanent reset.
Correct. And it showed up in the gross profit story, too. Gross profit for the quarter was $605 million on that $5.95 billion revenue, a gross margin of 10.2%. For the trailing 12 months, it's 10.8%. Those are thin but manageable margins for a used car retailer, where the money is really made on volume and financing.
You mentioned SG&A. What happened there?
SG&A expenses for Q4 were $611 million. Gross profit was $605 million. SG&A was 101% of gross profit, meaning CarMax spent more on selling general and administrative costs than it earned selling cars in this one quarter. That's the single most alarming data point in the report. It's a seasonally weak quarter, but still.
That's why the new CEO's first act is cutting $200 million in SG&A. The math demands it.
Exactly. Now, CarMax Auto Finance. CF income fell 9.8% in Q4 to $143.7 million. Two pressures. The outstanding loan balance declined after they securitized a $900 million non-prime pool in Q3, and they increased their loan loss provision as delinquencies rise. Their Tier 3, near subprime originations are now 9.8% of volume. That's a new customer segment, but one with real credit risk.
Cash flow?
Full fiscal year 2026, operating cash flow of $1.78 billion, free cash flow of $1.24 billion. The business generates real cash over a 12-month cycle. Q4 specifically showed negative operating cash flow of $554 million, completely seasonal, as CarMax builds inventory for the spring selling rush. That Q4 inventory build happens every year.
And the balance sheet?
Corporate cash of $123 million. That is an extremely thin cash buffer for a company this size. Total debt, $2.77 billion. Net debt, $2.65 billion. $4.1 billion in inventory. Those are cars sitting on lots across the country ready to sell. And $17+ billion in auto finance receivables, which is CarMax's massive loan book. Total assets, $26.4 billion. Stockholders' equity, $5.9 billion.
Dividends, buybacks?
No dividend. CarMax has never paid one. They do buy back shares. Fiscal 2026 total buybacks were approximately $643 million, though they pulled back significantly in Q4 to just $54 million, likely preserving cash given the operating loss. Overall financial health rating, watchful. Positive cash generation over a full-year cycle, but margins under structural pressure. Q4 losses are concerning, and $123 million in cash is not a comfortable position heading into uncertainty.
All right. What are the analysts saying?
13 analysts cover KMX. Consensus hold 4 buys, 8 holds, 1 sell. Average price target $42, essentially flat to today's $41.60. The range runs from 35, JP Morgan's low, to 48, Baird's high.
So consensus says stay put. The stock beat the quarter and the street says meh.
Baird is the exception. They maintained outperform and raised to 48 from 44. They see real value in the transformation story under the new CEO. Stevens moved their target from 39 to 43, staying equal weight with cautious optimism on cost discipline. RBC raised from 37 to 41, still a hold. JP Morgan held their target at 35 and maintained hold, the most cautious, questioning whether gross profit per unit can recover sustainably.
The stock sold off on earnings day despite the beat. Beat the numbers, fell anyway.
Classic sell the news dynamic combined with real uncertainty. The Q1 guidance was the problem. Management called for the largest single gross profit per unit decline of fiscal 2027 in Q1. That takes momentum off the table. Investors saw the adjusted beat, but they also saw a CEO with no auto experience guiding for further margin pressure in the very next quarter.
Let me make the bull case. First, the stock is genuinely cheap at 0.21 on price to sales and 1.04 on price to book. Second, the tariff environment is a real tailwind. New car prices going up from import tariffs pushes buyers into the used market. CarMax's market.
Third, the new CEO bet may be correct. Barr's challenge at CarMax, digitizing the customer journey across hundreds of locations, is exactly what he did at IHG with thousands of hotels. The skill sets transfer more than most investors credit, and he's already acting decisively on cost discipline.
Fourth, the former CEO bought nearly 11,000 shares at current prices. Mark O'Neill knows where the bodies are buried in this business, and he's buying. Fifth, if the $200 million SG&A reduction comes through by fiscal 2027, on a thin margin business with $17 billion in revenue, that leverage is enormous.
Now the bear case. Gross profit per retail used unit, $2,115 in Q4, down $207 year over year. Management guided Q1 fiscal 2027 for the largest expected annual decline, approximately $300 per unit, or another 13% drop. If this metric keeps falling, no amount of cost cutting closes the gap.
And Carvana.
Carvana trades at 3.65 times price to sales, 17 times CarMax's multiple. The market has voted digital wins. If CarMax can't close the digital experience gap in the next 2-3 years, that valuation gap could persist or widen. Meanwhile, the class action lawsuit alleging CarMax overstated tariff-driven demand momentum adds legal uncertainty. And the CAF book, 9.8% Tier 3, rising delinquencies, is a $17 billion credit risk that could escalate quickly if unemployment rises.
Let's look at where CarMax sits in the competitive landscape.
The peer table is striking. CarMax trades at 0.21 times price to sales. Carvana is at 3.65 times, 17 times the multiple. AutoNation is at 0.29, Lithia Motors at 0.23. The traditional dealers are all priced similarly to CarMax. Carvana is in its own universe.
So the market is essentially saying, in the pure used car space, if you're digital native, you deserve a massive premium. If you're a traditional operator trying to go digital, you get a value multiple.
Precisely. The question for CarMax's multiple is, can the omni-channel model close enough of that digital gap to earn some of that premium back? At 15% of retail units sold online today, they're moving in the right direction. But Carvana is at a very different scale and trajectory. The gap to close is wide.
Before we wrap, let's check the options market. What's the sentiment?
Put-to-call ratio of 0.48, below 1, which signals more call activity than put activity. That's a mildly bullish options sentiment. Implied volatility percentile is at 52, moderate, reflecting the stock's recent volatility history, but with IV typically compressing after an earnings event. The market had priced a 10 to 12% move into the report. The stock traded in that range.
And any meaningful insider activity beyond what we mentioned on the new CEO?
The standout is Mark O'Neill, former CEO and current director, purchasing 10,816 shares on the open market. That is not a token purchase. A former CEO buying at these levels knows exactly what they're buying. John Daniels, the CAF president, sold 1,540 shares, routine planned transaction. Net, insider buying is the dominant signal and it's positive.
Let's talk through the watch points for the next quarter.
Number 1, gross profit per retail used unit. Management guided for approximately $300 per unit decline in Q1 fiscal 2027, the steepest expected drop of the year. If that number comes in better than guided, it signals the margin floor is closer than feared. If it's worse, the bear case accelerates.
Number 2,
CarMax Auto Finance credit quality. Delinquencies on auto loans are at decade highs. Watch the provision for loan losses in Q1. If it spikes meaningfully, the $17 billion receivables book becomes a much larger risk than just income pressure.
3 and 4,
Same-store sales trends. Retail unit comps were negative in Q4. Any improvement there would be encouraging. An SG&A trajectory. Can Barr's team actually demonstrate progress toward the $200 million savings target in the first full quarter of his tenure? The early signal matters for credibility.
bottom line time. CarMax sits at a genuine crossroads. America's largest used car retailer, a 30-year-old brand that pioneered no-haggle transparency, is now trying to build a digital competitor to Carvana while managing a captive finance book under stress. A new CEO with no car industry background and a stock that has lost half its value from peak.
The financials are watchful. Positive full-year cash generation, but Q4 GAAP losses, thin corporate cash, and structural margin compression make this a conviction hold at best and a speculative bet at current prices. The adjusted EPS beat of 34 cents was real, but it beat a 22-cent expectation that reflected how badly the street had already marked down expectations.
The metric to watch is gross profit per retail used unit. If that number stabilizes, stops declining by Q2 fiscal 2027, the transformation story has a foundation. Until then, this is a company in transition with more question marks than answers.
And the tariff wildcard. If import tariffs on new vehicles push meaningful volume into the used market, that could be the external catalyst that makes the KMX recovery happen faster than organic execution alone.
We'll close with Keith Barr on the Q4 earnings call. CarMax's omni-channel model, the ability to serve customers wherever they are in their buying journey, online or in a store, is our core competitive advantage and what we're doubling down on. A new CEO with a clear conviction about the path forward. Now he has to prove it.
Whether that bet pays off in time is the central question for KMX investors in fiscal 2027 and beyond.
That's going to do it for this episode of Charged Alpha. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.